An £80,000 salary sounds like you've made it. But after income tax, national insurance, pension deductions, student loans, and ordinary adult life, it can feel nowhere near as rich as the headline suggests. Today, I'm putting £30,000, £50,000, and £80,000 through the same UK payslip. What actually hits your bank account every month? What disappears before you ever see it? And what is the one pay rise decision that decides whether earning more actually makes you wealthier? Because the biggest shock is not just how much HMRC takes. It is how little of a big pay rise reaches your real life if your spending rises with it. Before we get into the numbers, let's set the test up properly, because this is where most salary videos fall apart in the comments. We have three people. Sam earns £30,000. Jordan earns £50,000, Alex earns £80,000. All three are employees in England, Wales or Northern Ireland, are below state pension age, have a standard tax code and have no other income. For the main comparison, I am not deducting pension contributions or student loans yet. We will add those next because they can make two people on exactly the same salary look like they live in completely different financial worlds. These figures use the 2026 to 27 tax year. The personal allowance is £12,570. Income is taxed at 20% up to £50,270, then 40% above that. For a standard employee below state pension age, national insurance is 8% on earnings between £12,570 and £50,270, then 2% above that. If you live in Scotland, your income tax bands are different. And if you are watching this after the 2026 to 27 tax year, check the latest thresholds, because tax rules can change. Right, let's start with £30,000. Because £30,000 does not feel ordinary once you see what actually reaches the bank. Sam earns £30,000 a year. A lot of people hear that and think, that is roughly £2,500 a month. It is not. £2,500 is the gross number. Here is the actual maths. The first £12,570 is tax-free. That leaves £17,430, which is then taxed at 20%. So Sam pays £3,486 in income tax. Then national insurance. Sam pays 8% on the same £17,430, so Sam pays roughly £1,394 in national insurance. Put those together and the total is £4,880. That means roughly £4,900 leaves Sam's payslip before a single bill is paid. His estimated take-home is £25,120, or around £2,093 per month. Not £2,500, £2,093. That is the number that actually lands in Sam's account before pension deductions, student loans, rent, food, travel, or anything else. Now, £2,093 is not a catastrophe, and £30,000 is not a bad salary. But location, rent, debt, childcare, health, family responsibilities and commuting costs can make that number feel completely different from one person to another. For a renter in a major UK city, fixed costs can easily absorb most of it before the month even gets moving. And that is why structure matters so much here. A £100 automatic saving or investing contribution every month may sound small, but it is not about pretending £100 solves everything. It is about building margin, the gap between what comes in and what life immediately takes away. At £30,000, the people who get more resilient are not always the people with perfect discipline or no challenges. They are often the people who build even a small automatic buffer before every spare pound gets absorbed by day-to-day life. And once you understand what £30,000 actually delivers, the jump to £50,000 starts to look very different from how it feels in a job offer email. £50,000, more money, but not a finish line. Jordan earns £50,000, same starting point. The first £12,570 is tax-free. That leaves £37,430. All of that remains inside the basic rate income tax band of 20%. So Jordan pays £7,486 in income tax. National insurance is 8% on the same £37,430. We therefore have total deductions of £10,480. Estimated take-home is therefore £39,520, which is roughly £3,293 per month. So the gross salary rose by £20,000, from £30,000 to £50,000. But Jordan's monthly take-home rose by roughly £1,200. That is meaningful. For a lot of people, that is genuinely life-changing money if it is directed deliberately. But it is also where things often go wrong. A bigger flat, a newer car, more holidays, more eating out, more subscriptions, more reasonable monthly commitments. Lifestyle inflation rarely arrives as one stupid purchase. It arrives as 5 reasonable monthly commitments that quietly become very difficult to unwind. And before Jordan has made one obviously reckless decision, that £1,200 monthly gain can disappear into a more expensive life. £50,000 is not a finish line. It is where many people first get enough financial margin to make serious progress, if they do not silently spend the entire pay rise. There is also something important if you are sitting near £50,000. The higher rate income tax threshold is £50,270 in England, Wales and Northern Ireland. So a bonus, overtime payment or modest pay rise can push you into the 40% band. That does not mean your entire salary gets taxed at 40%. Only the slice above £50,270 does. But it does change the value of every extra pound you earn from that point onward. Which brings us to Alex. £80,000, the made-it salary. Alex earns £80,000, and this is where the numbers get more interesting, because Alex earns across 2 income tax bands. The first £12,570 is tax-free. From £12,570 to £50,270 is £37,700. That is taxed at 20%, which is £7,540. Then Alex earns £29,730 above £50,270. That slice is taxed at 40%, so £11,892. Total income tax is therefore £19,432. Now national insurance. Alex pays 8% between £12,570 and £50,270, which is £3,016. Above £50,270, employee national insurance falls to 2%, so an additional £595. Total national insurance, £3,611. Add income tax and national insurance together, and you get a total tax bill of £23,043. That means roughly £23,043 leaves Alex's payslip before rent, food, pension contributions, student loans, or anything else. Estimated take-home, £56,957, or roughly £4,746 per month. Not £6,667 a month, which is what £80,000 divided by 12 looks like. £4,746. That is the real bank account number before other deductions. And yes, £4,746 per month is a lot of money. There is no pretending otherwise. It gives Alex substantially more choice than Sam or Jordan. But here is the danger at this salary level. The lifestyle can expand almost as fast as the income. A bigger mortgage, car finance on something newer, private childcare, a second holiday. More expensive habits. The kind of spending that feels completely reasonable at £80,000, but creates a fixed monthly cost base that is hard to unwind if work, bonuses, health, or family circumstances change. At £80,000, the danger is not that you cannot build wealth. It is that your life expands fast enough to make you feel exactly as stretched as you did at £50,000. The three salaries side by side. Let's put them next to each other. Sam at £30,000 takes home roughly £2,093 per month. Jordan at £50,000 takes home roughly £3,293 per month. Alex at £80,000 takes home roughly £4,746 per month. The first salary jump, from £30,000 to £50,000, is £20,000 gross. It creates roughly £1,200 more per month after income tax and national insurance. The next jump, from £50,000 to £80,000, is £30,000 gross. It creates roughly £1,453 more per month after income tax and national insurance. Think about that. An extra £30,000 in gross salary creates only around £253 more per month than the previous £20,000 gross increase. That is because every pound Alex earns above £50,270 faces 40% income tax, 2% employee national insurance. So around 42 pence of every pound above that line goes to HMRC in this simplified base case. Alex keeps around 58 pence before pension contributions, student loans, and other deductions. Your salary goes up, but the value of each extra pound changes as you move through the tax system. Why two £50,000 salaries can feel completely different. Now we get to the hidden layer. The reason two people earning the same salary can have completely different bank balances, even before either has made a bad financial decision. Pensions and student loans. Workplace pension. If Jordan is auto-enrolled into a workplace pension and contributes the statutory 5% employee minimum on qualifying earnings, the calculation changes. For 2026 to 27, qualifying earnings run from £6,240 to £50,270. Jordan earns £50,000, so qualifying earnings are £43,760. A 5% employee pension contribution is £2,188. That is roughly £182 a month going into Jordan's pension before considering the contribution method. The employer contributes at least another 3% under the statutory minimum, so £1,313. That employer contribution does not appear in Jordan's bank account, but it is still part of his total pay package and future wealth. The exact effect on Jordan's take-home depends on the scheme. With relief at source, some tax relief is added after the employee contribution is made. With net pay, the contribution is taken before income tax. With salary sacrifice, the payslip can look different again, and national insurance may also be affected. But the principle is simple. A pension makes your bank balance lower today, but may make your future wealth much higher, especially once employer money is included. Student loans. Student loans work differently depending on the plan. For 2026 to 27, Plan 2 repayments start above £29,385. Plan 5 repayments start above £25,000. Repayment is 9% of income above the relevant threshold, not 9% of your entire salary. So for Sam on £30,000 with a Plan 2 loan, his repayable income is only £615. At 9%, that is roughly £55 per year, or around £5 per month. For Jordan on £50,000, £1,855. That is roughly £155 per month. For Alex on £80,000, £4,555. That is roughly £380 per month, and that is not small. For many borrowers, student loan repayment can feel more like an extra 9% deduction from income above the threshold than a conventional loan repayment. But whether you repay your loan in full depends on your future earnings, interest, the plan you are on, and how long you remain in the repayment system. Unlike a normal bank loan, income-contingent student loans are generally written off after a set period if they have not been fully repaid. But that write-off date depends on your repayment plan and when you started your course. Plan 5 borrowers start repaying earlier than Plan 2 borrowers because the threshold is lower, £25,000 rather than £29,385. That means two people on £50,000 can have very different real bank balances. One may have a workplace pension contribution and a Plan 2 loan. Another may have neither. Same £50,000 gross salary, completely different real-world take-home. What to do with a pay rise? Knowing your take-home pay is useful, but knowing what to do with a pay rise is what actually changes your life. Every time your take-home pay rises, there is a short window before the extra money becomes normal. Before the nicer car, before the bigger rent, before the upgraded habits. That is the moment to capture part of it. A simple framework is to split the net pay rise 3 ways. 50% toward future wealth, pension contributions, ISA investing, debt overpayments or mortgage overpayments. 30% toward life now, a real lifestyle improvement you genuinely enjoy. 20% toward resilience, emergency savings, insurance, or sinking funds for car repairs, home maintenance, and the boiler. Take Jordan. His monthly take-home rises from roughly £2,093 at £30,000 to £3,293 at £50,000. That is around £1,200 extra per month. A 50-30-20 split could look like £600 toward future wealth, £360 toward enjoying life now, £240 toward resilience. The lifestyle still improves, just not by the full £1,200. This is not a rigid rule. If you have high-interest debt, you may put more toward clearing that first. If you are rebuilding after a difficult period, the resilience category may need to come first. The point is not the exact percentages. The point is this. A pay rise only becomes life-changing if some of it stays out of your lifestyle. If every extra pound goes into monthly spending, you have raised your cost of living. You have not raised your financial floor. Final message. Sam, Jordan, and Alex are not simply earning different salaries. They are living with different tax rates, different marginal rates on every extra pound, and potentially very different real take-homes once pensions and student loans are added. The gap between gross and net is not just a tax story. It is a lifestyle story. The people who get ahead are not always the people earning the most. They are the people who capture some of every pay rise before life has a chance to absorb it. £30,000, £50,000, and £80,000 are not just salary numbers. They are 3 different sets of choices. The goal is not to look rich on payday. It is to build enough margin that one bad month does not erase years of progress. Which salary jump would change your life most right now? £30,000 to £50,000 or £50,000 to £80,000? And what would you actually do with the extra money? Drop it in the comments. I read them, and it helps shape what I cover next. If you want to understand why you can be genuinely good with money and still not feel like you are getting ahead, watch that video next. And if you want to know whether putting more into your pension is actually worth it, watch the pension maths video after that.